You've probably heard that real estate is the best way to build wealth, and you're about to find out whether that's actually true and, more importantly, which version of real estate is right for you, because there's a version that requires $50,000 minimum, months to exit, and a 2 a.m. call when the furnace dies. And there's a version you can buy from your phone for $10 and sell before lunch. And there's a version that markets itself as the best of both and quietly delivers neither. That question sounds simple. It's not, because REITs, rental properties, and platforms like Fundrise aren't just different versions of the same thing. They're three completely different financial instruments with different rules, different risk profiles, and different consequences if you pick the wrong one for your situation. In this video, we're going to break down all three. You'll see the real return math, not the version that real estate influencers put on YouTube, but the one that includes the expenses they never mention. You'll get a clear decision framework based on how much money you have and how much of your time this is actually worth. And you'll walk away knowing exactly which path makes sense for where you are right now. This is educational content, not personalized financial advice. Now, let's get into it. $60,000. That's a rough ballpark of what you might leave on the table over 10 years by keeping $100,000 sitting in a high-yield savings account instead of putting it into a diversified REIT position. We're talking the difference between roughly $150,000 to $160,000 in a decent savings account versus something closer to $200,000 or more at a historical REIT return rate. These are illustrative estimates. Your actual results will vary, but the gap is real. It compounds and it starts on day one. But here's where it gets complicated. Picking the wrong real estate vehicle or buying a rental with the wrong assumptions can eat most of that gap back. Someone who locks money into a platform like Fundrise without understanding the fine print or buys a rental property that doesn't cash flow can end up with returns that barely outpace doing nothing. This decision matters, and the gap between best and worst outcome is wider than most people expect. Let's start with what you're actually buying in each case, because this is where most of the confusion starts. Option 1, a public REIT. A real estate investment trust is a company that owns income-producing real estate, apartment buildings, warehouses, data centers, hospitals, and is legally required to distribute at least 90% of its taxable income to shareholders as dividends. You buy shares through a standard brokerage account the same way you'd buy a stock. You can start with $10, you can sell in seconds. You don't own any specific building, you own a slice of a company that owns buildings. Option 2, a direct rental property. You buy a physical property, become a landlord, collect rent, and hope the combination of rental income, mortgage paydown, and price appreciation adds up to a return worth the effort. The minimum here isn't $10, it's typically $50,000 to $100,000 in a down payment and closing costs depending on your market. The average 30-year fixed mortgage rate is currently around 6.5 to 7%, and liquidity means listing the property, finding a buyer, and waiting months to close. Option 3, crowdfunding platforms like Fundrise or Arrived. These platforms sit in the middle. Fundrise lets you invest with as little as $10 into private real estate funds called REITs that they manage. Arrived lets you buy fractional shares of individual rental homes. You don't pick the tenants, you don't fix the pipes, but you also can't sell tomorrow. Most positions lock for 3 to 7 years, and during market stress, platforms can restrict redemptions entirely. Here's the key framing before we go any further. Most people think of this as a slider. There's more returns, equals less, but that's not how it works. These aren't different intensity levels of the same investment. They're three completely different risk-return trade-offs with different tax treatments, different liquidity profiles, and different failure modes. Let's talk about returns and start with the one thing most companies get wrong: historical returns. Long-term REIT data shows total annual returns, dividends plus price appreciation, averaging somewhere in the 9 to 12% range over multi-decade periods, according to industry data. That includes some exceptional errors. Most recent windows look more like 7 to 9%. VNQ, the most popular REIT ETF, has delivered roughly that range over the last decade. It's not the headline number you'll see in promotional materials. It's competitive with the broad stock market and materially better than what most people earn on private real estate. But manage your expectations. REITs dropped nearly 30% in 2022 alone. These aren't bonds. Fundrise, reports net annualized returns of roughly 7% over the life of the platform, about 5.75% in 2024 and 6.24% in 2025, with a significant negative yield in 2023. Rental property is harder to pin down because it depends entirely on your market, your leverage, and how well you operate it. Long run, unleveraged real estate returns cluster around 6 to 7% globally. With leverage and a well-bought property in a solid market, you can realistically target the low to mid-teens, but that requires the deal to actually work, which we'll get into in a bit. So far, this looks like REITs win, but here's where it gets more complicated: the leverage effect and the hidden cost. Rental property math looks much better once you factor in leverage. When you put $50,000 down on a $250,000 property and that property appreciates 3%, that's not a 3% return on your money. That's $7,500 on a $50,000 investment, or 15%. The tenant pays down your mortgage. You get the appreciation on the full asset, not just your down payment. That's the leverage story rental property advocates lead with. And it's real. But here's what they don't put on their thumbnail. Here's where the math gets real and where most YouTube channels only show you half the picture. Let's run two scenarios. Scenario A, you buy in an expensive coastal market, $250,000 property, $200,000 loan at 6.5%, annual debt service roughly $15,000, gross rent at 7% of value, $17,500, operating expenses at 50%, $8,750 NOI. After debt service, you're cash flow negative by more than $6,000 a year. You're not collecting a check, you are writing one. Now, that $6,000 isn't the full economic picture. Your depreciation shield is saving you roughly $2,300 in taxes a year. Your tenant is paying down around $4,000 to $5,000 in mortgage principal in year one. And the property is hopefully appreciating on the full $250,000, not just your $50,000 down payment. So the actual wealth being built may be positive even when the checking account isn't. But you need to understand exactly what you're buying before you commit, because if a vacancy hits or the HVAC dies in year 2, that cash flow deficit becomes a real emergency fast. Scenario B, you buy a Midwest cash flow market, think Cleveland, Memphis, Indianapolis, same $250,000 price point, but rent yield is 10%, $25,000 gross annually. You self-manage or use a lean operator, cutting expenses to 40%. NOI, $15,000. After the same debt service, you're near break-even or slightly positive. Not a windfall, but the tenant is covering the mortgage while the equity builds and the tax advantages compound. The point isn't that one scenario is right and one's wrong, it's that rental property is not one thing. The influencers only show you scenario B. A lot of investors only budget for scenario B and end up living scenario A. Your market and your expense ratio determine whether this works, not the asset class itself. Now let's talk about liquidity. REITs sell in second during market hours. Rental property, listing, marketing, finding a buyer, closing, is typically months. Fundrise, now this one surprises people. During the 2022 to 2023 rate shock, Fundrise significantly restricted its quarterly redemption program, limiting how much investors could withdraw and when. If you needed cash on your timeline, you were waiting. There's also a 1% exit penalty for redemptions under 5 years. You own a quarterly update, not an asset you can sell on a bad news day. Minimum to start. REITs and Fundrise both win here. You can start either one with your lunch money. Rental property, however, requires you to already have capital, which filters out a significant portion of viewers from this option entirely, at least for now. Taxes. This is where rental property pulls ahead decisively. Rental income is sheltered by depreciation, a paper loss you take on the building over 27.5 years that can reduce your taxable income to near zero even while you collect rent checks. You can also deduct mortgage interest, operating expenses, repairs, and property management fees. Here's a number worth sitting with. On a $250,000 property where the building value is around $200,000, you depreciate roughly $7,200 per year as a paper loss, even if the property is appreciating in value. In a 32% tax bracket, that's a tax shield of around $2,300 per year. Over the full depreciation schedule, we're talking tens of thousands of dollars in real tax savings on a single property. This is what high-income rental investors mean when they say their rental lost money on paper. They mean they paid less to the IRS while collecting rent checks. REITs don't give you this. And when you sell, a 1031 exchange lets you roll your gains into a new property and defer capital gains taxes, potentially for decades. This isn't a permanent tax elimination. When you eventually sell without rolling forward, you'll owe capital gains and depreciation recapture taxes. But the ability to keep deferring, keep compounding, and keep building is a structural advantage the REITs simply don't offer at the individual level. REITs pay dividends. Those dividends are mostly taxed as ordinary income, not at the lower qualified dividend rate. For a high earner in a taxable account, that's taxed at up to 37%. There's a 20% deduction available under Section 199A, recently made permanent, which brings the effective rate down to around 29.6% at the top bracket. Better than it used to be, but still worse than a rental property sheltered by depreciation. Fundrise sits in the middle. Some return of capital distributions give you a deferral benefit, but it's less powerful than direct ownership. Hidden costs. Fundrise charges 1% annually, 0.85% asset management plus 0.15% advisory. Over 20 years on $100,000, that fee costs you roughly $40,000 in lost compounding versus a public REIT ETF with a 0.1% expense ratio. That's before factoring in the lower returns. Arrived charges a 3.5% sourcing fee upfront on every property, plus ongoing management fees and property management costs that collectively eat into the headline yield significantly. Rental properties' hidden costs aren't fees, they're surprises. A roof replacement, a 2-month vacancy, an HVAC unit that fails in August. Estimates vary, but setting aside 1% of the property value per year for capital expenditures, plus a 5% vacancy buffer and 5% maintenance reserve, puts your true expense ratio closer to 60% of gross rent, not the 50% we modeled above. Before the scenarios, let's clear 3 questions that always come up. REIT ETFs versus individual REITs. By the ETF, something like VNQ gives you instant diversification across hundreds of properties and sectors for about 0.1% a year. Picking individual REITs requires sector-level conviction that most investors don't have. Default to the ETF unless you have a specific reason not to. House hacking. If you're early in your career, have limited capital, and can stomach living with tenants, this is one of the highest return moves available to you. You use owner-occupied loan terms, potentially 3 to 5% down, rent out the other units, and often cover most or all of your housing cost without building, while building equity. The research in this video doesn't fully apply here because your return calculation includes a housing cost offset that changes the entire math. Crowdfunding alternative, Realty Mogul, Ground Floor, and others. These target accredited investors with minimums of $25,000 or more and marketed returns of 12 to 20% IRR. The actual risk is higher. You're concentrated in individual deals selected by a sponsor you've probably never met, with no secondary market and no guaranteed liquidity event. Platform and sponsor risk is real. In 2023, a prominent crowdfunding platform had investors lose tens of millions of dollars due to sponsor fraud. The deal looked fine on paper, right up until it wasn't. Do not commit capital without independent due diligence on both the platform and the specific sponsor. If you're not accredited and you're considering Fundrise because you want returns like this, manage your expectations. The realistic net return is closer to 7%. Here's the decision tree: 3 questions, clear branches. Branch 1, or not yet. If you don't have the capital for a down payment and closing costs, or you're not willing to tie up that liquidity in one asset, the answer is straightforward. REITs, specifically a low-cost REIT ETF through a major brokerage, are your path to real estate exposure right now. You get diversification across hundreds of properties, instant liquidity, and returns that have historically matched or outperformed private real estate over long periods. Fundrise is an option here too, but compare its 1% fee to REIT ETFs 0.1% and ask yourself whether the private exposure is really worth 10 times the cost. Pause this video right now and check one thing. How much uninvested cash do you have sitting in a checking or savings account above your 3-month emergency fund? If that number is more than a few $1,000s and you don't have a plan for it, it's losing real purchasing power every month. REITs let you put it to work today with no minimum and no lockup. Branch 2. Yes, I have the capital, but I'm not interested in being a landlord. If you have the money but want fully passive exposure, REITs are still the answer, not Fundrise. The 1% annual fee and the liquidity restrictions are real costs you're paying for convenience that a REIT ETF already gives you. Unless you have a specific reason to want private, non-traded real estate exposure, a low-cost REIT ETF probably solves the same problem for less. Branch 3. Yes, I have the capital and I'm willing to run this like a business. Direct rental property is worth serious consideration, but only if 3 conditions are true. First, the market you're buying in still pencils at current mortgage rates. With rates at 6.5 to 7%, you need either a lower purchase price or higher rent to value ratio than the national average, or a meaningful down payment to make cash flow work. If the numbers don't work after running them honestly, including capex, vacancy, management, and your time, don't force it. Second, you have reserves. The industry standard is a minimum of $10,000 in a dedicated capital expenditure reserve per property, untouched by your personal finances. No reserve means one HVAC failure wipes out an entire year's cash flow. Third, you understand this is a business, not a line item in your portfolio. Bigger Pockets will tell you rental property is the fastest path to wealth. Dave Ramsey will tell you to buy in cash and avoid leverage. The truth is likely somewhere in between. Rental property with disciplined underwriting, adequate reserves, and leverage you can carry through a vacancy cycle can produce strong long-term returns. Rental property bought on optimistic projections with thin reserves and full leverage is a financial emergency waiting to happen. Life stage note. If you're under 35 with limited capital, start with REITs. Time is your biggest asset, and starting now matters more than starting with the right vehicle. Also, seriously consider house hacking, buying a small multifamily with a low down payment, owner-occupied loan, and living in one unit. It's the highest return entry point to real estate that doesn't require $50,000 in the bank. If you're 35 to 50 with capital and stable income, this is the peak window for direct real estate. Full stop. You're in your highest earning years, which means depreciation shelters the most income. You have enough runway that a vacancy cycle or a bad year doesn't derail retirement. The leverage math works best when you have decades of compounding ahead and income to absorb short-term pain. If you're ever going to own rental property, this is the decade to do it. If you're 50 to 65, approaching retirement, this is the time to reduce complexity, not add to it. If you own rentals, transitioning equity into REITs via 1031 exchange or gradual liquidation removes the operational burden. If you don't own any, a REIT sleeve in your retirement account is cleaner than becoming a new landlord at 55. If you're retired, REITs work well here. Mandatory 90% dividend payouts, instant liquidity, zero operational burden. One caveat, when you're drawing from a taxable brokerage account at a high income, REIT dividends taxed as ordinary income can be costly. In that case, hold REITs inside your IRA or Roth IRA, not in taxable accounts. I want to say something that might surprise you, coming from a video that just made a pretty clear case that REITs are the right default for most people. The smartest critics of that recommendation aren't wrong. Graham Stephan, who's built significant wealth through direct real estate, makes a legitimate point when he argues that REITs can't replicate what direct ownership actually gives you, the 1031 exchange, the depreciation paper loss that shelters real income, the ability to refinance and pull equity tax-free, the ability to force appreciation through renovations that REITs, owned by institutional management teams, capture at a different scale than you do. Bigger Pockets makes an equally valid point that the passive income framing around REITs is a bit misleading. When a REIT's share price drops nearly 30% during a rate shock, VNQ was down roughly 28% in 2022. Your real estate position dropped 30% too because the market said so. The underlying buildings didn't move, but your net worth did. Direct property ownership insulates you from that daily volatility, not because the buildings are worth more, they might not be, but because no one is quoting your price every 30 seconds. And here's the one that fee-only certified financial planners raise that rarely makes it into YouTube videos. If you hold REITs in a taxable account, you're paying ordinary income tax on most of those dividends every year, even if you never sell anything. That's a tax drag that doesn't exist until sale for direct property, and it compounds against you over decades at high income levels. The honest answer is that REITs win for most people because most people don't have the capital, the time, the market access, or the operational appetite to run direct real estate as a business. But if you do have those things, the tax advantages and leverage dynamics of direct property can meaningfully outperform. The mistake isn't choosing REITs over rentals or rentals over REITs. The mistake is making the choice based on someone else's YouTube channel without running your own numbers. Mistake 1. Comparing yield to yield without accounting for taxes. A 6% REIT dividend and a 6% rental property cash-on-cash yield are not the same after-tax return. If you're in a 32% tax bracket holding REITs in a taxable account, that 6% becomes roughly 4% after federal taxes on the ordinary income portion. A 6% rental yield sheltered by depreciation may be largely tax-free in cash terms. The compounding gap over 10 to 15 years on a meaningful position is substantial. We're not going to give you a single precise number here because your actual bracket, return, and assumptions will vary, but directionally, you're talking about a 6-figure difference over a long enough time horizon. The fix is simple and free. Hold REITs in your IRA or Roth IRA where dividends compound without annual tax drag. Do not hold them in a taxable account if you can avoid it. Mistake 2. Buying rental property and skipping the capex reserve. You budget for your mortgage, taxes, insurance, and property management. The roof lasts 25 years, the water heater lasts 10, the HVAC runs 15. When they go, they don't care about your spreadsheet. On a property collecting $2,500 a month in rent, ignoring capital expenditure, reserves of roughly $300 per month, means the first time something structural breaks, likely in years 5 to 10, you're looking at an $8,000 to $15,000 unbudgeted hit in a single year. That's not a bad investment. That's a miscalculation that turns a good investment into a stressful one. Mistake 3, treating Fundrise like a high-yield savings account. The platform is designed to look like one, a clean dashboard, quarterly returns, regular distributions, but your money is locked in a non-traded private REIT. During the 2022 to 2023 rate cycle, Fundrise significantly restricted its quarterly redemption program, meaning investors who needed cash had to wait, often much longer than expected. If you're putting money into Fundrise that you might need in the next 3 to 5 years, you've made a liquidity decision that the platform's marketing didn't make obvious enough to you. Mistake 4, assuming real estate prices will solve for you. In 2021, with 3% mortgage rates and rapidly appreciating markets, even mediocre rental deals looked good because the appreciation bailed you out. That window is closed. At 6.5 to 7% mortgage rates and current price levels, many markets in the US do not pencil for new investors without a significant down payment or unusual rent to price ratios. The question isn't whether real estate is a good long-term investment. It is, probably always will be. The question is whether your specific deal in your specific market at current rates is a good investment. That math has changed materially since 2021. Run the current numbers on your own math. Don't use pre-2022 assumptions. Mistake 5, not investing at all. This is the most expensive mistake in the entire video. Someone who holds $100,000 in cash, unsure whether to choose REITs, Fundrise, or wait until they can afford a rental property doesn't avoid the decision, they make it. They chose the option with the worst expected outcome. At a historical REIT return rate, that $100,000 could plausibly reach somewhere around $200,000 or more over 10 years. In a high-yield savings account at current rates, it might reach that $50,000 to $60,000 gap is the price of analysis paralysis, and it's money you gave up for the privilege of feeling careful. These are rough estimates, not guarantees. Your results will depend on returns that nobody can predict. But the direction is the point. Analysis paralysis has a price tag, it's just a slow one. Here's the framework, not just the answer. The decision between REITs, rental property, and crowdfunding platforms isn't really about which one has the highest headline return. It's about matching the right financial instrument to your actual situation, your capital, your tax bracket, your time, and your risk tolerance. For most people, especially those earlier in the saving journey, those who want genuine passivity and those who don't have $50,000 to $100,000 ready to commit, REITs are the right default. A low-cost REIT ETF through a major brokerage held in a tax-advantaged account where possible gives you diversified real estate exposure, institutional quality management, instant liquidity, and historical returns that have beaten private real estate over full market cycles. Start there. If you have the capital, the market access, the reserves, and the operational appetite to treat real estate as a business, not a passive income fantasy, and it makes sense in your market, direct rental property can produce meaningfully better after-tax risk-adjusted returns, but only if the numbers work at today's rates in your market, and only if you build in the reserves before you need them. Fundrise and Arrived are not a middle path between these two. They're a compromise that collects real costs, fees, illiquidity, and reduced transparency without delivering the best qualities of either. They may have a role as a small satellite position for investors who want some private real estate exposure and understand the trade-off. They should not be anyone's primary real estate strategy. One more thing, and this is what actually determines whether any of this matters. The difference between the person who builds real estate wealth over 20 years and the person who doesn't isn't which vehicle they choose. It's that they choose one and stayed in it long enough for time to do the work. The most expensive mistake in this video isn't choosing REITs when you should have bought a rental. It isn't picking Fundrise over a REIT ETF. It's spending another year running comparisons while your money earns nothing. Your market is the variable, not your optimism, not your spreadsheet, not this video. Go run the numbers on your actual situation with your math, and then do something with what you find. Disclaimer, this content is for general educational purposes only. It's not personalized financial, investment, tax, or legal advice. I am not your financial advisor. I don't know your full situation. The numbers and examples in this video are illustrative. Your actual returns will depend on your market, your tax bracket, your timeline, and decisions that only you can make. Before making major real estate decisions, consider consulting a qualified, certified financial planner who can look at your whole picture. All investing involves risk, including the possible loss of principal. Past performance doesn't guarantee future results. Verify current IRS rules at irs.gov before acting on any tax information. For you, the next question is which type of REITs actually belong in your portfolio. Equity REITs, residential, commercial, data centers, and how they fit into a broader investment strategy. Let us know your take in the comments. If you found this video useful, subscribe. Every video on this channel is a decision framework, not a verdict handed down from a guru. See you in the next one.